Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
This is going out there. It's August 23rd. My friend Curzio, the Wall Street Unplugged podcast, where we read the headlines and tell you what's really moving these markets. What's funny? My washing machine broke again. I think I go through a washing machine every 3 years, ever since they put like the environmental features on there and stuff like that. I know Trump said something about that recently. It's so crazy, right? So I'm under warranty with Best Buy, and we call them and they say, okay, we're going to come in a week, which is a long time when you have kids in school and stuff like that to get your clothes done. So I'm like, okay, no problem. We're going to come in a week. So they're planning to come, and I think it was on Wednesday or whatever. And on Tuesday, we didn't hear from them. So I'm like, okay. I give them a call late at night and say, hey, I didn't hear from you. Your window's 7 to 7, right? So I guess, you have to be there. So I want to be in the house. Like, nobody works, right? That's what these people think. And they said, well, we changed your appointment. And I said, well, why didn't you email me? You emailed me with the appointment and showing, saying when we booked the appointment, I got an email, I got a text and everything. Oh, we sent it to you. I was like, I didn't get it. What are you talking about? They said, well, the part didn't come in. I'm like, what part are you talking about? You didn't look at the machine yet. They're like, well, based on what you said, we're figuring what the part's going to... I've never seen this in my life. I've never seen a company do this before, right? So basically, they ordered a part and sent it to our house, and it didn't show up at the house yet without the guy coming and looking at it, which spells disaster. So the next day, the day it's supposed to come, I call him, the part gets to the house. And I say, hey, the part's here. Can we have the same day? They said, we can't do it. We have to push it out a week. I said, so now it's 2 weeks out. I said, you got to be kidding me. So I'm pissed off. I'm ranting and raving saying, okay, you take off of work, right? If you take off work, you got to be the whole day. Then you don't even tell me that you're changing the appointment. You don't even call me. This is Best Buy, by the way. So now the next week comes, the guy comes. And I told him, I said, I'd never seen this before. He goes, yeah, it's a whole new system where, based on the comments, it's all automated, and they'll order the part. So basically what happens is he goes there, and it's 2 weeks later now, and comes back out like an hour later. He goes, it's the wrong part. I said, great. So now I have to wait another week. Now we're going on 3 weeks. Great guy, by the way. He's like, the system sucks. He's like, I get so many complaints about it. He's like, listen, here's my direct number and call me. He's like, I ordered the part one day. It's supposed to come in like 1 day shipping, so 2 days altogether, whatever. It's still not there a week later. So now they just cancel me again. So if they came the very first time, they would have known what part they needed. They could have ordered it, and it would have been done probably in 10 days. We're on 3 to 4 weeks now, and it's still not going to get done. That's the customer service that you're getting right now. When they say, hey, you want to pay an extra $30 for the warranty or an extra $80 for the warranty? Fucking don't get it. Don't get it. It's a waste. It's like insurance for an airline. Oh, you have to write in personally and do that. You think like, oh, okay, I'm canceling the flight. It's a whole process to get your money back. It's this massive process that most people don't do, and that's where they make money. That's why they're selling this stuff. All these warranties. I mean, the margins on that, holy cow. Anyway. And we're right at the 3-year part where, I'm glad I called, but it's going to be after 3 years and the warranty at the time they fix this thing. But it's a washing machine, right? It's hard. I got to go to one. Anyway, my personal problems. I got to throw them at you. That's what this podcast is for. Because we're all seeing craziness in the markets right now. And today, by the time you get this podcast, you get a little bit around the same time Nvidia is going to report. Nvidia's report today is massive. This is the company that's been helping keep the market up. If this company shits the bed, look out. You're going to see a 3% decline in the S&P 500. They're probably not, because you have so many analysts. They probably talk to management. Expectations are sky high. Expectations have never been greater heading into a call for any company that I've ever saw in my life. And I'm going to explain that right now. So you're looking at them reporting Q2. They're expected to earn $2.08 shares on $11.2 billion in sales. Okay, they're going to beat those estimates. The biggest thing is going to be the guidance. Their guidance, remember, they were expected, $7 billion in sales last quarter, right? So when they reported Q1, the guidance was supposed to be around $7 billion. They raised it to $11 billion. So now you're expecting at least $12 billion in sales this quarter, even though they said $11 billion. Their guidance for next quarter, that's going to be a big deal. They're expecting, the guidance, expecting $12.6 billion But expectations, and you look at a whisper number for the analyst reports, it's more like $14.5 billion. That's the number. Okay, so if they come in at $13 billion, that's going to be a disappointment. It's going to say a beat estimates because all these guys who raise their numbers, and by the way, we're talking about all these analysts, there's 49 of them. There's 49, and I think something like 43 have a buy rating on the stock. Everybody's raised their numbers and estimates into the quarter, but they didn't raise them high enough, right? Obviously, because they want to make sure they beat, and that's what drives the stock higher. That's all you hear. Nvidia beat estimates. You don't know what those estimates are. Those estimates could have been revised 20%, 30% lower. These have been revised higher, but all of them know they should be revised significantly high. Even some of the reports I read said, listen, our numbers are at 12.3, consensus is 12.6, but, there's numbers out there that are looking at 14.5 billion. So why don't you put it at 14.5 billion if that's what you think? Again, it's a whole game with Wall Street. Now, for fiscal year 2024, the expectations are $43 billion in revenue. Just know that's 61% year-over-year growth. And 8,027% earnings, that's about 246% year-over-year growth. And they're expecting 69% margins. Now, I wanted to look at the 2025 estimates, because again, they're in Q2 of this year. So, 2025 in terms of their estimates and looking at it, fiscal, it's not long. It's not that far away. So let's see what 2025 expectations are. So you're looking at a company where earnings are expected to grow to $12.60 from $8.27. Whatever, 50% growth or so. And then they expect margins in 2025 to go from 69% in 2024 to 73%. They expect margins to go higher. So a few things, okay? Because everyone's going to break down Nvidia and tell you what they want. You're going to see. So I just want you prepared. Maybe you'll listen to this before. Maybe you'll listen to this after. If you listen to it after, I love that because, you hold me accountable. And I'm saying this stuff before the report, not after. And saying, I told you so. When you go on and say, Nvidia is probably going to beat. I think the stock can go higher, but it might go a little bit lower. And then the next day when you're reporting on CNBC, you're like, hey, I told you so. What did you tell me? You told me it could go lower, could go higher. They're probably going to meet estimates, and they take credit for it, right? That's Wall Street. I got to give Cramer credit because he had Foot Locker. Foot Locker got destroyed. I'll cover that in a minute. And at least he owned it. And that's fine. Because people get on Cramer, and I've gotten on Cramer. I disagree with him sometimes. And again, there's a person I work for, a person I know. We went to my wedding. But if you're looking at those FANG stocks, he's one of the ones that invented that. Okay, so if you're looking to criticize that guy's been riding these stocks for the past 10, 12 years. Okay, and he's got a lot of losers, but it's fine. You could talk about your winners a lot. When you talk about your losers, most people don't. And I credit him because he really got that one wrong. And he said, I got it wrong. It's on me. And I like that. Okay, that's how you learn. And just to show you, no matter how many years experience you have in this industry, you're always going to learn. So be humble. Trust me, because I was arrogant. I've been arrogant. And man, I got punched in the face every single time I get ahead of myself. And I think I'm the greatest person in the world when it comes to analyzing stocks. That's what this market does to you. This is crazy. Now, a few things with Nvidia. I'm not sure how they're going to grow margins with so many competitors entering the market, right? These are very deep pockets that are entering the market, right? These companies. And it's significant. So you're going to look at orders and you have to look at the lead time for these orders because the lead times to get these chips right now is out past 9 months. Meaning if you place an order for NVIDIA's chips, you're not going to get them for 9 months. That's what's going on right now. That's how long it is. That's significant. Again, you're booking orders now and your wait time is over 9 months, meaning you don't have that capacity. So you have to either build more fab plans, try to get more capacity through Taiwan Semi, whatever. But it's taking a very, very long time. Now, 9 months in technology is like 10 years in other sectors. And if you want proof, 9 months ago, NVIDIA was trading at 120. And I went from a footnote to the greatest trend in technology since the creation of the internet. This is 9 months. 9 months ago, everyone was going, AI is the greatest thing. Oh my God, all the technology. Everybody went crazy. Pretty much it started around 9 months ago, 8 months ago. But NVIDIA was trading at 120. What is it, 450, 460? Now, over those 9 months and going forward, so over the next 9 months, you have AMD, Intel, Broadcom, IBM, all spending boatloads on AI. I know I threw IBM in there, but it's true. And you're like, IBM, again, these are small. Intel, you got to be kidding me. Okay, but you also have chip startups like Mythic, Tatium, and they raised over $15 billion in capital over the past 2 years to make new AI chips. Also, this is unusual, the biggest tech companies are entering the space. We're talking Meta, Amazon, Microsoft, Apple, and Google are making their own AI chips. Now, why would they do this? Why would they make their own AI chips? Why would they get into this industry, which is usually a shitty industry? I mean, you used to have Ford, GM, anyone that makes chips, they used to be like, this is what we need a chip to do. Go ahead, guys, go bid. It was a commoditized business, not Nvidia, because you have the best of the best, and these are the chips you need and you have to use, and they control 70% of the market right now when it comes to AI. They're getting into this because Nvidia, again, they're controlling 70% of the market, but they generate an incredible 70% margins on hardware. That's unheard of. Need to remember something. These companies, if you're looking at the top 6 in technology minus Nvidia, have close to $1 trillion in cash on their balance sheets. Enough to poach the best players from Nvidia, enough to put in a ton of money, hire great talent, and go crazy. The whole entire world is coming for Nvidia. And if you're making $10 million a year as a developer for Nvidia, that's awesome. But Apple can pay triple that and have these guys say running their own divisions when they might be the number 2, number 3, number 4 at these places at Nvidia. So when you look 9 months from now, this industry is going to look very different than what it does right now. And why is that important? Because when you're looking at Nvidia and where it trades on what the future is, what the future valuation is. Maybe 5 years, maybe 10 years out. This is on the future of what it's going to earn. Because even if Nvidia is able to generate, this is 2025, $12.60 a share in earnings. Massive, massive increase, 50% increase, and what is it? 400% increase from 2023, whatever it is, 2023 levels. If you put this company at $500 a share, which it's almost at right now, maybe it's a little bit higher, when things are going to go a lot higher, but if it's at $500 a share, at $12.60 in earnings in 2025, which is remarkable, the stock's going to be trading at 40 times forward earnings. Now, you deserve a high premium when you're growing. That's not expensive, and you're growing. And Nvidia is growing right now, but we're talking 9 months from now. On that call, it's not about how much they earn. They're going to blow out these numbers. They're low. They're going to destroy them. It's the guidance. And the guidance should be very strong, but you better get on that call and listen to the lead times. That's going to determine if Nvidia is going to go up and be up for a few weeks and then probably come down really, really hard over the next month or two. Because they need to get these chips out sooner than 9 months because of the competition coming in. And I can't see Nvidia growing at this pace over the next 24 months with the massive amount of competition that's entering the space. Again, I just can't see them generate 70% margins. And more competition is going to lead to price wars. And I see the biggest dangers for Nvidia, not from the heavyweights entering this industry, some of them for the first time, but it's from the Intel and IBMs. These are the guys that have absolutely nothing to lose. And they'll go all in, offer massive incentives for new developers, give away their stock for free. That's what these companies should be doing. I mean, they've been such shitty companies for so long behind every single freaking trend. This is your chance to go 100% all in that a trend, this is going to be a massive trend. There's no doubt. The spending is there, the money is there, the AI is there. It's incredible. You can ask any question on ChatGPT, anything. Even my daughter, I was doing fractions with her last night, which I forgot, of course. And just said, and then there was a question. I was like, a question with, a bunch of numbers and stuff. And again, you got to brush up just a little bit on it, I was like, I'm just curious. Let me put this in ChatGPT. And it answered it in 2 seconds. And showed me the formula and everything in 2 seconds. I mean, it's real, this trend. Absolutely. But I'd be more worried about the guys that have their backs to the wall, that are going to do anything to make sure that they become a major player in this industry. So I see them more of a threat than the companies, even with the big pockets, who haven't really been in this industry before. So this is a company that's going to drive the market. And it's important because it's the one name you can look at and be like, okay, we're okay. I mean, you look at the technology falling off, you look at the banks falling off, you're seeing oil still maintaining, but kind of not surging the stocks as they were a couple months ago. We're in a lot of those names. They did well for us throughout our portfolios. But where's the leadership going to come from? Because right now it's coming from AI, it's coming from Nvidia. And one last thing, I want to ask you this question. How big do you think the AI market is, or projected to be in 2025? Think about a number, and I want you to just say it wherever you are, what that number is. What is the projection, right? for AI. What's the total addressable market for AI in 2025? What's the amount? It's just $100 billion. Sounds like a big number. Tokenization has the potential to be a $16.5 trillion industry. So SPACs were created, right, to create liquidity for insiders and get them out of illiquid investments, which are private companies, and you turn them into publicly traded, merge them with those publicly traded entity, right? This way you can get out a lot quicker. And that's such a big, massive trend. That's why tokenization is all the banks launching their own blockchains and putting and tokenizing all their assets. Imagine having liquid assets that you could sell little bits and pieces of. That is amazing. That's what they want to do. They don't want to be locked up in commercial real estate and bonds and stuff like that. It's hard to sell. Now anyone could buy these things. That's what they're doing right now. That's a $16.5 trillion trend. A trend that we're in. The first ever tokenized our company. But the total addressable market is $100 billion, and that's by 2025. This could be a $1 trillion market by 2030. But it just goes to show you and put in perspective how much hype we've seen in AI. I mean, it's a fascinating trend, but it's going to take many years for even the largest players outside of Nvidia to make money. And that goes for Microsoft as well, saying in the quarter, we're not really going to see anything meaningful until, at least the second half of 2024. And this is one of the biggest, second biggest company in the world, market cap. $2.5 trillion company going all in on AI. That's how long it's taken. On the software side, incorporating AI into your business. This isn't like Rivian. This isn't like Tesla, where you have companies going all in and they wake up and breathe EVs. This is like Ford and GM saying, oh, we want to incorporate this, EVs into it, so we're going to like half-ass go into this trend and see how we do. That's what companies are doing right now. It can't be a big part of your business unless you want to be like Tesla and Rivian and lose tens of billions of dollars a year before the trend finally picks up, right? Because you're not going to generate money. It's so hard to incorporate this and actually make money off of it. So this fascinating technology, it's going to take time to implement. And that means if you're holding these software AI companies, look out, because eventually you have to put up the numbers. You can't be like Disney and say, oh, we have 100 million subscribers, 112. We have more subscribers than everyone in the industry and Netflix, and we're the biggest in the world. Yeah, but you're giving away for free. You're not making shit. You're not making any money. And then investors finally came around and said, oh, wow, those names, they're not going to pay for your services because you're not providing any new content, because all your new content has to come out in the movies. Wait a minute. I'm just going to go to Netflix and pay for Netflix. And that's why you're seeing Disney where it is. Eventually, you have to show those numbers. You could have the greatest story ever, but you have to put up the numbers eventually, especially in this market where if you're not putting up the numbers and you talk about the massive growth, you're probably sitting on huge amounts of debt, which is getting more and more expensive to service. Something to think about. Let's see what happens after the close. Expecting revenue guidance close to $14 billion. The expectations like 12 and a half. Anything less, I think, is a little bit of a disappointment, considering, again, there are 50 analysts covering the stock. There's 50, not 40, but 50 analysts covering the stock for Nvidia. 43 have a buy rating on it. Only one has a sell. And I have to say, 80% of those analysts raised their numbers over the past 2 weeks leading into this call. When you talk about company expectations sky high, if you are long this market, you better hope at the end of the day, Nvidia reports really, really good numbers and drives that stock higher, or it doesn't collapse. If it collapses, you're going to see an ultimate market collapse. You're going to see a 2-3% decline in the S&P 500 because everything right now in terms of growth is linked to this, because you're not finding growth anywhere in anything. Maybe outside offshore drilling in a couple areas here or there, but it's ugly out there. Because when we look at the rest of the market, I think the Fed's done raising rates. It's the first time I've said that. The first time I've said that in 2 years. They should be done raising rates. I mean, you're seeing a lot of things roll over right now. A lot of things roll over. And you're looking how high interest rates impact everyone else, even outside the U.S. I mean, you look at France, Germany, broader Eurozone. Service manufacturing PMI came in below 50, showing contraction, yet inflation is ticking back up. Imagine being in that situation. Holy cow. What a nightmare. China, ultimate disaster. If you get a chance, Kyle Bass, great interview on CNBC this morning. He believes China's going to take over Taiwan next year. That's going to happen next year. You're seeing Taiwan exports are down tremendously, right? That's technology. We're supposed to believe that technology is great. It's great in NVIDIA. Outside of NVIDIA, not so great. And we're talking about, 25-30% exports out of Taiwan. Again, they make most of the chips for the world. Down tremendously. Best Buy's coming up. Let's see how that quarter is. The stock has gotten annihilated. Let's see where demand's going. But he thinks that's going to happen next year. And he says this is based on what she is saying and doing. When a lot of times we'll see different things and everyone analyzes it. You're reading a story about someone's opinion. Sometimes you just have to sit back and listen to the person talking. And not listen to all the assholes with all the opinions. Sometimes. And I could be one of those assholes. Because if you listen to Powell, he's doing exactly what he said he's going to do over the past, 15 months? I'm raising rates. We're going higher. We have to get down to 2%. And how many times since then, since the last, 16 months, whatever he's been started since March, raising rates, how many times have we heard on TV from, not dozens, hundreds of analysts that the Fed is done raising rates? Just not believing what he's saying. Yet he's telling you exactly what he's going to do. I'm raising. We got to get down 2%. I'm raising a rate so we get down 2%. The jobs number is still strong. Wages are good. You're seeing productivity come back. I'm still raising. And he's actually saying we're probably going to continue to raise. I'm just saying, based on the recent data, what I'm seeing, it's crazy. Because even when you get back to China and you listen to Kyle Bass, I'm going to try to get him on this podcast. Because he was talking about how, she listened to what he's saying and what he's doing. Also, I was surprised that he's supposed to attend the BRICS conference, canceled last minute. Nobody knows why, which is interesting. But when they asked him on Squawk Box, should they invest in China? Since, again, that growth is going to come back and China's going to be great and their economy is going to be fine. That's what he said. He said, let me put it this way to you. One of the best analogies I've ever seen. Because China's GDP rose over 500% in the last 15 years. Yet, if you invested in their primary index, S&P 500, which is the Shenzhen Shanghai 300 index, you're down 31% over the same time frame, over those 15 years. Think about that. If you compare to the U.S., regrew our economy by 70% over the same time frame, and the S&P 500 is up over 300%, including dividends. Why? Because we have trust in our markets, we have government oversight, rules, regulations that are in place. We believe in numbers, you have to sign off on them. In China, even he said, where's all the money go? It doesn't go to the Westerners. How are we benefiting from investing in China? You can invest in companies here that have exposure to China. That's fine. But investing directly in China, why? And where's all that money going? It's going to the party. It's going to politics. It's not going into your hands, the shareholders. No. But how can you have an economy where the GDP grew 500%, but your major index, right? Your primary index is down 31% over that same time frame? Think about that. You want to invest in China based on that? Good luck. Because I can tell you, the next 15 years, there's no effing way that they're growing GDP by 500% or even 100% for that matter. So where do you think those returns are going to go? That's why you have to be careful of China. When you're dealing with a communist nation, it's for the party. That's what you deal with. That's why the U.S. is the best place to invest. Why the dollar is so strong. But again, we see de-dollarization and a lot of countries trying to wean themselves off the dollar because the U.S., they don't want the U.S. to control everything they do through the SWIFT system. And they want to be able to trade in dollars, whether it's oil or different things in India and Latin America and different things, in case that happens. And that's why they're testing the waters. And that's why you're seeing the global share of the U.S. when it comes to dollars decline. And it's down significantly. It's down 8% alone in 2022. So that's China. That's Europe. You're seeing higher rates hurt them and still inflation in some areas. But we're seeing the banks roll over, right? More downgrades are expected from the credit agencies. Also, tighter regulations are coming. Oil, you could say the stocks topped a little bit for the moment. You had a lot of momentum there. I still think oil's going to go higher. Tech is terrible. Again, you've seen those exports out of Taiwan, which are terrible. Outside of Nvidia, tech has been horrible. And then you say, okay, well, it's time to get into the safe names. No, you got to annihilate Kellogg's, Colgate, Verizon, UPS, which is, getting a little bit of momentum. Now they solved their little strike thing. You look at Citigroup, British American Tobacco, so-called safe stocks are trading near 3-year lows. Not 3-year lows. These are the names you go into. Oh, I got the dividend. Well, I don't need the dividend now. I don't need your 2.5%, 3% dividend because I get 5% risk-free. So now I'm buying Colgate based on your company and growing your company. And Verizon growing earnings and sales, and they're not doing that. That dividend was that sweetener. Hey, I can get in. 0% rates. At least I'm getting 3% dividend. That's cool. I love that. Forget about that. If you're looking at the buyback yield compared to the dividend yield, more companies are buying back their stock now. And as an investor, you want that. You're going to get more out of your money. You get much, much better returns. S&P has a study on this going back to 20 years showing companies that buy back their stock outpace dividends by a lot. Okay, we doing a promotion on this, and we started recommending a lot of companies buying back a large percentage of their float. That's what you want to see. Because the dividend's kind of meaningless when, oh, we got 3% dividend. Well, I get 5% risk-free. I don't need your yield. I need your company to kick ass and grow. That's what I need right now. And you're not seeing that. I mean, we thought earnings season, mostly over, and now we got the latest batch of earnings. Yesterday was Macy's, shit the bed. Dick's Sporting Goods, down 30% plus. Credit to Daniel. I told him to sell that stock, and he did. We were going back and forth. He's like, I wanted to sell. I said, all right, it's cool. And he made the decision to sell. And that stock got crushed, and we took a nice gain on it. So, it's been doing good. He's not going to be here tomorrow, by the way, so I can talk positive about him. I don't want to talk positive about him when he's here. But good job on him. But look what happened to Dick's Sporting Goods. And then mentioning theft and all this crap. I'll cover that tomorrow. Got annihilated. Today, what was it? Peloton and Foot Locker. Holy cow. Destroyed. But what are you seeing now? You're seeing companies, you could only cut costs so much. And yes, these companies did a great job cutting costs, slashing inventory. But at the end of the day, you need to see some kind of demand come back into the market. And we're not seeing it in many areas. Especially areas like Foot Locker, Dick's Sporting Goods, Nike, down 9 straight days? But look at the companies that focus on the younger demographic. Because these are the ones that now have to pay student loan debt again. You turn that back on, and they're sitting on massive amounts of credit card debt, where rates are now at all-time highs. You want to talk about eliminating a consumer from the market, and that's a big consumer. That's a big demographic, but you're seeing it. Again, this is what higher rates does to this market. This isn't just something that happened and it's, a one-timer. It's a hurricane that destroyed insurance company. It's not a one-timer where, we'll get it. This is something that's in the market that's going to be here for a while, high interest rates. They're not going to go away for a while. Fed's not going to lower. Maybe they lower next year, maybe whatever. But even if they start lowering, that's when the market, if they start lowering, watch out. Because that's telling you that the economy is not doing well. That's why they're lowering. They're not going to lower, but they should stop. Because what you're seeing out of earnings right now and how crazy it is, the reason why I tell you, Money Flow Trader has done shit the first 6 months of the year. But man, if you get a name like this or a sector like this that just shits the bed, this is where you make a fortune by buying long-dated puts. Just protecting a small part of your portfolio. You need to do that now. It's very, very dangerous. I've been warning you about this for the past couple of months. Because higher rates, it's this never-ending drag that keeps getting worse and worse. And it's starting to filter into the housing market now, where for the first time in history, listen to this, a new home costs less than an existing home based on the median selling price of a U.S. single-family home. You see, new home prices supposed to be much more expensive, but home builders got smart and said, you know what? Let's start creating smaller homes, not these big mansions and stuff like that, and sell them. So this means if you have an existing house, good luck selling it. You're not going to be able to, since you can buy a new home for basically the same price or maybe a tiny bit cheaper right now. And this happened to me. I'm giving you first-hand experience. I mean, my mom moved to the Villages in Florida. I bought her a house here. Paid about $225 for it. Market went crazy, went all the way up. It went over $400,000. I tried to sell it for $425 last year. Then the market started pulling back a little bit. I said, let me go to like $415. And then my real estate agent, who's very familiar with the area, said, look, you're going to have to go lower. He goes, go to $375 and sell it. And I was like, I don't want to go that way. He goes, you have to go that low. Why? Because they're building a massive home complex, which is close to 95, right where I am, where the average price for a new home was under $400,000. I'm competing with brand new homes. I have to come below that price. So existing homes have to come down, or you're not going to sell them. So I had to lower the price, and we sold it. I have my other house, my existing house on the island, I'm not even getting anyone to look at it, and that was the hottest market you could ever see because new homes aren't allowed to be built on it because it's, they say it's an island, it's like 11 miles wide, or it's, Amelia Island. But still, that market, even here in Florida, lower taxes, safer, better. When the prime areas, you're starting to see a slowdown now. But if you have the choice to buy an existing home for say $400,000 or a new home for $400,000, what are you going to buy? Also, how many homeowners can buy a new home without having to sell their existing one? I don't know what the percentage is, but not many. But I could tell you they're never going to be able to sell their existing home within maybe a 2-month period, a 3-month period, because you'll look at another home and you put a bid on it and say, okay, I'm going to have to sell this house first. That deal's not going through. If you're a real estate agent, say, just find another buyer, because you're not going to be able to sell your house. Rates are too high. You're not going to be able to sell it unless you really discount it significantly. But that's going to be hard to do. You know, some people just want more money for their house and think it's worth a lot more. But how do you do that? How do you sell your house right now to a new buyer at these rates? I mean, skyrocketing rates, well over 7% mortgage rates. How do you sell that house to them and expect that buyer to get approved and everything okay with tighter lending standards? And then you have to close that out, and then you're going to be able to buy that home that you put a bid on? That's usually the way it works. Good luck. How are you going to sell your house? But when I look at these statistics and what's going on, it tells me the housing market has to come down sharply. The home builders are okay because they're building new homes at cheaper prices, and they're seeing demand for that. But existing home sales is becoming a dead market. And remember, housing is the biggest driver of economic growth in the U.S. and for most countries outside of the government, constantly every year, $6 trillion entering into the market, which they said they were going to stop last year, which is why the market took off the first 6 months. All because of the $6 trillion coming into the market. Again, trillions and trillions and trillions and trillions continue to come into the market. And now, higher rates, quantitative tightening. Again, this constant drag. So what does all this mean? It means buckle up. It's going to get a lot more difficult out there. The good news is you have the companies like Dick's Sporting Goods, others, they could lose 30% of their market value, market cap in a day. And maybe these names have further go down. That's okay. That's the adjustment you need to see. Companies like this should not be trading. Many companies should not be trading near all-time highs. And we're off of those in the past couple of weeks. August hasn't been a good month, but July was pretty good. And a lot of people got wrecked because people tried to short in July, a lot of hedge funds, and they went on the wrong side. And July was a great month. So maybe these names come down further, but that's when you want to buy assets when they're cheap. And we're in a market where rates surged, earnings have not grown year over year for 3 straight quarters, earnings recession, and stocks trading at all-time highs. I mean, something had a break, and now it's starting. But the positive side is if you prepare, right? It's an amazing opportunity to buy great companies at dirt cheap prices. And that's how you invest. Because markets like this don't come around often. You don't make a fortune by buying companies within a bull market. You make them by buying them when the market sells off and crashes, and you have this disconnect between the price and the stock. Something like PayPal. It's hard to find a company right now that's growing faster than PayPal, 400 million users. What a great name. That's gotten annihilated. I've never owned it. People tell me to own it 300, 200. Now it's down to a level where it's trading much cheaper than the overall market, growing 2-3 times faster than the overall market. Earnings are going to explode higher. Everybody hates it. It's totally out of favor. You can only buy PayPal in a market like this that's totally annihilated at that current price when it's expected to grow earnings and sales much, much faster than the overall market. It's been a shit show for that company. If you own it, I'm sorry. Now PayPal's a really good buy. That's what happens. So you're going to see separation between the best and the worst in each industry, not industries going up together. I mean, Nike's down 9 straight days. Walmart, McDonald's are doing great. Kind of put those in the same category. You look at Abercrombie reported last night, so a 30% decline in inventory. Stock is surging today. So not everything is a disaster, but you need to be in the right names and in the right industries. It's more relevant now than maybe it's been in the past 10 years. Because you could have been in the wrong name, and with 0% interest rates, you could still do okay. You were going to get annihilated. And a lot of people who made money in the first 6 months are getting annihilated right now because those are the names that are getting hit the hardest. I'm going to share a lot of those names and industries tomorrow's Wall Street Unplugged Premium podcast. And one last note, I want to thank all the new Curzio One members that came in. I presented with an amazing private placement opportunity to biotech that's about to disrupt a $100 billion a year market. $100 billion a year, yes. which is the size of AI. And not by treating autoimmune diseases, but actually providing a near cure. I'm not joking. Okay, I said that leading up to the special call that we had with the CEO last night at 8 p.m. He was open to Curzio One members and a few other investors, right? So, people like a cure, that's bullshit or whatever. I think every Curzio One member who listened to that call last night, and that was at 8 p.m., which is CEO, who's responsible for bringing 34 drugs to market, talked about 25 minutes about this new drug and why it could change the landscape of medicine. It was really, really exciting, seriously. I don't make any money from these companies. You're just investing alongside to me. I'm putting $50,000 into this. Curzio One, as you know, is our elite membership where you get all of our products and services free forever, right? You only get charged a small maintenance fee, and it's worth it because if you have products that you're going to ante up again and again and again in 2-3 years, we'll easily pay that. That's not the biggest value. The biggest value is getting into deals like this. It's a special private placement. We're coming in at a $50 million valuation where its signature drug showed 85% efficacy and no safety issues in its phase 1B study. And when you compare it using that technology to a similar drug, again, that uses that same technology, which is not targeting the immune system, but targeting disease. Everything out there, Humira and everything, they target the immune system. It lowers the immune system. And if you come off Humira, good luck. Your symptoms are going to get much, much worse, right? And the more you take, the lower your immune system goes, meaning the more safety issues you have. This is targeting the disease. It's different. And there's another company, similar technology, and this company we're investing at $50 million valuation has almost double the efficacy of this other company that just passed its phase 2 trial. And once it passes phase 2 trial, not FDA approval here. As soon as it passed phase 2, one of the largest pharmaceutical companies came and bought them up for $2 billion. So we see phase 2 studies, which are going to be done by the end of 2024 with this name. We're coming in at $50 million valuation. This company's going to be worth more than $2 billion. And this acquisition took place in December. It didn't take place pre-COVID or when, biotech was red hot in 2020, 2021. It just took place. That's the market for this type of drug right now. And these are the ideas that are open to Curzio One members. If you still have a few spots left, if you're interested in coming in, again, it's a high-priced, our highest, most expensive product. It's a great group of people. We only open this up probably every 6 to 9 months. I opened it up because of this opportunity, and it's a great opportunity for people to get in as a first private placement. Unfortunately, you have to be an accredited investor. If you're an accredited investor and own a lot of our subscriptions and services, all those current subscriptions that you subscribe to, you're allowed to take that amount off your Curzio One membership. We sent out a couple of emails just to a few people who usually request that, hey, put me on a list for Curzio One. If you want to see that, let me know, but let me know quickly because you have about another week and a half to invest in this, and that's it to closing it. And we only have a few spots left because I think we're going to go up over $1 million in Curzio One investors of how much money Curzio One and me are investing in this name. Again, I don't get paid by the company. I don't make any of them come in the same exact terms as you. You're just following me of the things that I invest in special ideas like this that come across my plate because of you. Because I have so many listeners to this podcast. We have a massive network, and it gives us access to really special ideas and a company like this that I'm really, really excited about. Based on risk reward, it's one of the best names that we invest in a private placement in Curzio One. And you'll see that because I have access to the call, which was last night. If anyone wants to see that call before they decide to come into Curzio One, I could share it with you. You can't get in unless you're a Curzio One member. Just let me know, frankcurzioresearch.com. And thanks because we did get a few people coming into Curzio One, which is our premium membership. And again, those are the people, you guys that drive us, that help us launch new products, that help our business grow. And I just want to say I really appreciate that and your trust. Really, really cool. So guys, tomorrow, Wall Street Unplugged Premium, I'm going to break down some sectors and stocks that I do like in this market that you should be in because allocation matters. It matters where you're going to be, where you can position yourself, because if you position yourself in the wrong place, you're going to see these massive losses on these stocks that you're seeing, and it's a dangerous market, and you have to be careful. But it is going to open up opportunities. I'll share a lot of those things, opportunities and stocks and different things that have a new recommendation for you tomorrow, and that's going to be on Wall Street Unplugged's Premium podcast. I'll see you guys then.